As usual, I would like to welcome everyone to our lesson today. We are at our 8th lesson, so we are about halfway with our course. And as you saw, in lesson 7, we have started to get into looking at trading strategies and identifying and capturing ways to identify and capture opportunities in the market. Um, we are now going to get into a different phase in the course in that we are going to be doing more and more of this work. We are going to be identifying trade opportunities. We're going to be talking about how to trade them. And when you look at the markets on your own, you're going to see many of these opportunities. And as you will quickly see, the opportunities that we identify will have tremendous profit potential. Nevertheless, I don't want you to rush into the live market. I still want you to practice some of these techniques, and I highly recommend you watch these lessons 2 or 3 times to get the concepts down and then begin to apply them in a paper trading or in a simulator mode until you refine and get the techniques down, and then go into the live market. And I know that it's very tempting, and I know that we all like to make money, and you will, except I just want you to go about it the proper way and not to rush too quickly, so that you give yourself ample opportunity to really learn and practice before you hit the live markets. And I say this because today you're going to see some very interesting things that I know you'll be tempted to try. So definitely try them, but in the context of a simulator or paper trading. All right, as usual, we have our disclaimer at the beginning that you need to take a few moments to read. And our agenda for today, we're going to take another look at the open. And in the last lesson, we talked a little bit about the open, and I expressed to you how important the open is. So we are going to probably spend quite a bit of time on the open. It is a great opportunity for trades, and not only that, it is a great opportunity for us to get a glimpse of what's going to happen in the market. And so as we delve into this more and more, you are really going to get a great appreciation for the power of the open. After talking about the various types of opens that we identified in our last lesson, we're going to talk about the open in relationship to the prior day, how the prior day impacts where the open is and what effect that has on the new trading day. And last but not least, and this is the part I know you're going to like quite a bit, is we're going to start looking at projections for the day's trading range. Even from the very early on in the day, we're going to learn some very powerful techniques in sort of how to project what the market is going to look like for the rest of the day. And as you get good with doing this, you will be amazed at the incredible opportunities it will present for you. All right, so back to the open. And let's review again from our last lesson. We covered that there were 4 different types of opens. We had the open drive, the open test drive, and today we're also going to talk about the 2 others that we didn't talk about in the last lesson, the open rejection reverse and the open auction. Let's review for a few moments the 2 that we did talk about, which are the open drive and the open test drive. And just to summarize what we had previously discussed, these 2 types of open are directional moves. Certainly they could be directional to the upside, or they could be directional to the downside. But the idea behind them is that they're directional in nature. The market is moving in a particular direction in a strong way in the open drive and the open test drive. So naturally, this tells us that the other time frame has stepped into the market, they're participating in the market, and they're doing it with a certain level of conviction. And we have to decipher what is that level of conviction. Certainly, an open drive has a far greater degree of conviction than an open test drive. But nevertheless, both of them are strong directional moves early when the market opens. I want to show you another quick example this morning of a failed open drive. It is often helpful or great to learn from things that fail rather than things that work, because we can quickly see why and where they failed. So let's take a look together at this brief video and analyze what happened at the open. Okay, now as you can see, the market opened and it immediately started in the downward direction. We didn't even have a test, continued on downwards. So this looks like a very strong open drive to the downside. Still strong, but now look, prices moved back up. And look at where the B period starts. If we look at the range of the movement to the downside, B period is actually starting above half of this move. So this is a rather bullish open for period B. And so when I see this, immediately I should question the open drive to the downside. Things are changing before my eyes. Look at where B period is opening now towards the high end. The next challenge that alerts me that things are starting to look different in the market, and I really should not get carried away with this open drive, is to look at what is going to happen at the actual open. So we know now, step one, that period B opened above half of the move. So sentiment is changing now. We're starting to become more bullish. Will this hold, or will it come back and continue in the direction of the open drive? Let's watch and see. Okay. Watch how B period pierced right through the open. So there goes my open drive. I don't have an open drive anymore. That condition no longer exists. It's a completely different day. If in fact the open drive would have worked, I would have found that B period would have continued lower and C period even lower than that, and so on. So this is a great example to show you when an open drive fails. And look at, even though it was a very powerful open drive, it still failed. Now take a look at what continues to happen in the market. At this point, the market has found value. The long-term traders have decided to step out for the time being. And so we only have the short-term traders in the market at this point. And notice we don't get much of a range expansion. They continue to do their two-sided trading, and we just carefully watch and see what is going to continue to happen. Then the long-term trader steps in at this point and takes the prices higher again. Look at that, and it keeps going. And now it's in a completely opposite direction of the original open drive. We actually ended up with a higher high than a lower low for the day, even though we started with a very strong open drive to the downside. So this is a definite failed open drive. And when you see these signs, you learn to identify them quickly. So don't get carried away simply because you see an open drive. It may turn on you, and you have to keep your eye open for these eventualities when they do happen. And you have to also remember, in terms of statistics, the powerful open drives that are incredibly profitable usually don't happen in the market that frequently, And then moreover, another tool that you will have that will help you with this is when we begin to look at the analysis from the prior days and look at the market in the larger context. All these, when we start putting all these elements together, you will see and you will find that you will have an incredible amount of valuable information right before the open, and you'll be better prepared than, I would say, the vast majority of traders. All right, now that we've reviewed our open drive and the test drive, the open test drive, and we've looked at a failed open drive so that you know what those look like as well, we want to talk now about the third type of an open, which is the open, rejection, and then reverse. And in here, here's what happens. The market opens at a certain price level and starts to trade in a direction. And then all of a sudden, it meets very strong resistance. This resistance is strong enough that it actually forces prices to move in the opposite direction. So prices reverse. And that's why we call it the rejection reverse. We move in a direction, but that direction is rejected. So we reverse direction and return right back through the opening range and start to move in the opposite direction. All right, let's review what happens in the open, rejection, reverse. As usual, we always start with an open. So the market opens at a certain price level. And then what happens is the market starts to move. In this case, in our example, we will say the market will move up. It could just as easily be it would be moving down. The direction makes no difference in the open, rejection, reverse. It is just that we have a strong directional move, just like we do in an open drive. But we meet strong resistance. So what is going to happen now is we're going to find that prices reverse and break through the open range. Now, this is a little bit different than the example I just showed you, because the failure or the rejection actually occurred in the first period. And this is typical of what happens in an open rejection reverse. It happens very early on and quickly. You see the price will move in a particular direction in a strong fashion, and then all of a sudden it'll meet this resistance, and then it reverses and breaks right back through the open. One other tool that you have in your arsenal that will really help you see this is the footprint. So in addition to watching the profile, as we have our footprint open and we actually look at the market activity, you will see how resistance comes into play, and all of a sudden the volume changes and the direction of the market changes when that resistance is encountered. Now, when we get this open rejection reverse scenario at the open, the key to trading it is really patience. As you can see, it wasn't obvious the direction that the market was going to move in. We tried to move in a certain direction, we hit resistance, and we changed direction. We could again meet a support level that would force us in the opposite direction. So since we are not quite sure who's in control and where the market is likely to move, patience is really the virtue that's required. We have to wait and see. And you will find, as you do more and more trading, that this idea of patience is an incredibly important virtue to have. All right, the open rejection reverse. Now let's take a look at it from the second period. So we saw what happened in A period. Let's take a look at, in our example here, what happens in B period. B period opens towards the low end of the range. So it's really telling me that, oh, things are getting bearish in the market. But notice what actually happens. It moves up again and comes back right to the open. And once again, here at the open is where I'm going to get my first clue as to what the day is likely to look like. Will the B period penetrate the open, or will it turn back around and reverse and take prices even lower? So when the B period returns to the open, we need to be attentive as to what is going to happen. Now, if in fact we can move beyond the open, the next test area is the high that we established early on where we met resistance. Conceivably, if we can break this high, we can continue even higher. Again, we are testing in both directions. This is typical of what you're going to see in this open rejection reverse day when this occurs. Now, the fourth type of open that we want to discuss and talk about is what we call an open auction. And unlike the open rejection reverse, the open auction is really very uncertain. It doesn't give us any clear idea about where the market is going. So the market opens and starts to trade a little bit above the open, a little bit below the open. We have a rather narrow range and a great deal of uncertainty. There's really no clear conviction in the market as far as direction. So number 4, or open auction, is really very different from the prior 3 that we talked about. The prior 3 all started out with some sort of a direction from the open. All right. In the open auction, when we have this occur, we need to start looking at the prior day for clues. We need to sort of look at the open and see where it is in relationship to the prior day's activity. And by the way, this is a very, very important skill to develop, and a very important task to always do if you are going to trade anytime during the day. You always want to take a look at the open and look back and see where did this open occur relative to the prior day. All right, so this is what we are going to do now. We are going to begin to take a look at the open and the prior day, where the open is relative to the prior day, and what does this tell us, and how does this help us in setting up our trades for the day. We're going to begin by looking at an open that's inside the prior day's range. And once again, to review with you, a range is the price movement from the low to the high, or the high to the low. So we look at the prior day and we look at the range for that day, and where is the open relative to that. And if in fact the open is inside the prior day's range, then there is a high probability of a non-conventional day developing or occurring. And I'm going to talk a lot more about non-conventional days and different types of days, but for now, suffice to know that this is the type of day that an open inside the prior day's range indicates. All right. The market is going to auction in one direction until activity slows. This is again in that open auction. And the open is inside the prior day's range. And I'll show you an example in a moment. The market auctions in one direction and until activity begins to slow down. And then it starts to auction in the other direction. All right. This is showing us the uncertainty. We're not quite sure which way we're going to move. And basically what that tells us is the other time frame trader is not present. They haven't yet stepped into the market with any large degree of confidence. And so what's happening is the short-term traders are still trying to sort out where value is going to be, and they really don't want to move too far with the trading range because they're not certain what's going to happen. They're being very cautious and very careful. When you begin to understand the behavior of the players, it really helps you in understanding the flow of how the day might flow. This is what the short-term traders are doing. The market opens and they want to know, is the time frame, the other time frame trader going to step in? Which way are they going to step in? And what kind of conviction are they going to step in with? The other time frame never announces, never tells anyone what they're going to do. And we have to discern based on their activity, and this is where the footprint also becomes very helpful, what in fact they are doing. All right. The open auction range generally will set the stage for a non-trend or a neutral type of day. So already I've identified or talked about two types of days that we will talk more about, a non-conventional and a non-trend or a neutral type of day. The low market conviction tells us that an early extreme is not going to be established or hold during the early period of the day. On many trading days, as you will see in some of the examples that we'll talk about, we're going to be able to identify either the low or the high of the day in this early trading period, certainly in the initial balance. And this happens very often where we can, in fact, identify the high and the low of the day during that first hour of trading. But when you get one of these non-trend neutral days, it is not going to be easy. You will not be able to identify, again, because of that uncertainty, which extreme is going to hold in the initial period. All right, let's take a look at these 2 days and take a look for starters where we have the open. And the open for day 2 right here is within the range of the prior day. And this is an open auction day. I want to show you a couple of interesting things here. Before I get into that, let's look at how narrow the range was for period A. We only had 3 prints above the open and 4 prints above below the open. So 3 prints above, 4 prints below, almost equal number. It shows you that uncertainty that I was describing in the open auction. Very characteristic of the open auction. The market just keeps fluctuating back and forth in a short, narrow range. All right. Now we're going to talk strategy a little bit in terms of how do we trade an open like that? How do we trade the open auction? And really, there are 3 steps to it. First of all, you want to wait for the extremes of the day to get established. What do I mean by the extremes? We either need to have a low of the day put into place or a high of the day put into place. Those are going to be the extremes for the day. So we wait until we're able to identify that. The next thing that we're going to do is identify where the value area is for the day. And then it's really quite simple. We're going to trade the value area extremes. So let me go back for a second to our prior slide and notice. First, we wanted to identify where the low is for the day. If we can identify that in fact it's going to be a low, then we know that this is the low extreme, and then we're waiting to identify the high extreme. In the meantime, we get a value area that develops. And when we get the open auction and we have a non-trend day like this, basically what we want to do is buy at the low and move up with it to the point of control, sell at the high, and move back down with it to the point of control. There isn't a big move to be had, and it simply means that you need to be in and out fairly quick, and you're going to trade from the extremes. That's the strategy for an open auction non-trend day. All right, now, what if the open, as we saw, is also inside? We talked about being inside the range of the day. We're going to now talk about it being inside the value area. And this makes it more likely that we're going to see a non-trend day when it's both inside the value area as well as inside the full range of the day. Because what it really is telling us is the market did not move away from value. It still is only comfortable in this value range. So let's watch this other brief little video here, and let me show you what happens when we open inside the value area. Okay. Now watch again. 3 prints above the open, 4 prints below, very tight range, and notice most of the volume is trading in this area here. Continue on. Now look at B period. All right, now here's where we begin to identify the first extreme for the day. Since B period moved to the upside and continued above A, we have a lower low here, a higher low here, and the low for the day is probably going to be right here. So right away we know that our high extreme is going to be there, and we haven't gotten to it yet, but I can take shorts from the top and come back to the POC, and if in fact price drops down to this area down here, I would be able to take a long and take it up to the point of control. Now see that it's moving in a very tight range. Okay, once it gets up here, if I take a short, it moves nicely back to the point of control. Same thing again, we come back to the point of control. And notice we continue in this tight, narrow range around the point of control. This is what a non-trend day looks like. No directional moves, very tight movement, not really a lot of opportunity in the market. All right, we've talked about an open that's either inside the range or even inside the value area. And we talked about that if it's in fact inside the value area, that the likelihood of a non-trend day is usually fairly high, and we're going to get a narrow trading range. Now, what if the open is in fact outside the prior day's range? Immediately, this tells us something that is very important. It tells us that the market is out of balance. The fact that it is opening outside the range of the prior day naturally means that it's outside the value area of the prior day. So something must have happened to push prices out far enough to get it to open beyond the range, either above or below the range. And obviously, we know that the one thing that has the capability of doing that is the other time frame trader. So we already know, by virtue of the fact that the open is outside the prior day's range, that the other time frame trader has been active in the market. The next question that we need to answer for ourselves is, what is their conviction? Are they really going to continue in this new outside days range or not? So it is very important to realize immediately when you get a market that opens outside the prior day's range, is that the market is out of balance. It's outside its value area, and that there is a good potential for a dramatic price move in either direction. Now, if the open is outside the prior's day, this type of open auction activity will often give rise to what we call a double distribution trend day. And again, I will show that to you, but basically you will have two different value areas within the same day. When the open is outside the prior day's range, it suggests the other time frame trader is involved in the market, and our job again is to discern and identify and detect what they're doing and with what conviction. So we begin to try to answer the two key questions that I always want to have you keeping in the back of your mind. What direction does the market really want to go in, and how well is it able to do that? And how well is it able to do that is really a function of the conviction of the other time trader. So if we're going to summarize our discussion for the open, we've really talked about 4 different types of opens, and each one tells us something a little bit different about what is going to happen in the day, and also tells us something different about the degree of market conviction. The first 2 that we talked about have high market conviction because they're directional in nature. In this case, the direction happened to be to the downside, but the open drive and the open test drive are looking at directional types of markets. And we now need to know, or they basically tell us which direction the market wants to move in. And the second key question that we have to ask for ourselves is, with what conviction? What is the level of power? And once again, the other tool that we will use to accompany us in this analysis to help us is the footprint, to be able to look at volume, who's coming in at the bid and the ask, and what is the level of conviction. Then lesser in terms of conviction is the open rejection reverse, where the market moves up in a direction, so we have some directional bias, and then all of a sudden it comes back right through the open and changes direction on us because of this resistance that it met, and then it might continue on in this direction, or if in fact it meets support here, it may start moving back up in the opposite direction. So that's the open rejection reverse. Then the least conviction and the greatest level of uncertainty we're going to see in what we call the open auction. It's completely open. We're not quite sure what is going to happen, and it's characterized by this back and forth movement, up, down, within a very tight and limited range. And usually this is going to occur when the market opens right within the heart of value area of the prior day, the value area of the prior day. So hopefully now you have a good grasp of the different types of open, and I want you to start looking at openings each day and identifying what is happening. The best way that you're going to learn this stuff is to practice it. This is very powerful, very important information. All you need now is really to practice. Practice it first as you get it down, as chart for yourself each day. Was I able to accurately diagnose and identify the type of the open? And if not, identify why not. Where did you go wrong? What misled you? And write that down in an agenda each day. And if you can, also print out the chart for that day so you can see and go back and reference it. And then put that chart in your binder. So each day you need to have at least one diagram telling you, were you able to identify the type of open or not, and if not, why. The best way for us to learn is to learn from our mistakes. So if you don't get it right the first time, do not be alarmed, don't be concerned. Nobody ever gets this all at once. It takes time and it takes practice, and I want you to do that. All right, now I want to review the concept of value and the idea of value and how we identify it on the profile. And basically, we begin to see value emerging when we see an overlap of TPOs. Basically, this is telling us that the market is accepting these prices and the short-term traders are feeling comfortable in this area. And the corollary to that, when this starts to happen, is we have balance in the market. We get a balanced market. So this is what we mean when we talk about value. More TPOs, more people trading at these prices, a larger number of TPOs developing on the profile chart, and a market that is developing balance or is in balance. All right, so here let's quickly see, this is the area where we see most of the TPOs. So even without looking at these two green lines, you should be now able to say, aha, this is right here, this is the area of value in the market. I want you to have at least developed the basic skills of now just simply looking at the market and being able to identify where value is in an instant, just by looking at a profile. All right, we talked about open within range, and now we want to talk a little bit more about open within the prior day's value, because it tells us a lot about market sentiment and how traders are likely to behave. First of all, since we're opening within the prior day's value, it tells us that market sentiment, the way that the traders feel about the market, has not really changed dramatically from the previous day. After all, we're still opening in the same value area where we were the prior day. So obviously, nothing has really changed. So that also tells me that the other time frame trader has not been involved. They're out of the market so far. It also tells me that trade risk and opportunity are both relatively low. Why is trade risk low? Because the market really isn't moving. It's not moving in any particular direction. So if I take a trade and I'm within the value area, whether it's a short or a long, if I'm just after a small gain, I'm probably going to get it as long as I am within that value area. And that's why the risk becomes relatively low. The opportunity is also low because, once again, we talked about the fact that if I'm going to do any trading, it is merely going to be for a very small, very tiny profit. I'm not really going to experience or witness strong directional moves in one direction or the other. Things are going to be confined to the value area. And when this happens, you need to also be aware that the day's range usually will be contained within the prior day's range or overlap on one of the extremes of the prior day slightly to one side. But typically it'll be within the value or within the range of the prior day. Depending on where we open in the value area, if we open on the high side, we may overlap a little bit and go outside of the value area of the prior day, and vice versa. If we open in the low end of the value area, then we may, in fact, extend the range of this day a little bit lower in the opposite direction. But more or less, we're going to be trading in a limited range when we open within the prior day's value area. Okay, now to a very important and powerful technique that I want to introduce you to, and this will be important for you to learn. It'll help you tremendously in your trading. And this is the ability to project the day's trading range. This is really when you are now going to see or begin to see the power of the profile and how it can give us an edge as traders. All right, in estimating the day's trading range or projecting the day's trading range, there are 4 key things that we have to begin by doing. First, we're going to look at where the open is. We're going to determine the open relationship to the prior day's value and range. So where are we opening relative to the prior day? The next thing that we want to do is to actually calculate, and I will show you how to do this, the prior day's range. And then step 3, we're going to identify what we call the initial extreme. And that is either the low or the high that is likely to hold for this new day. And then we are going to add the prior day range parameters to this identified extreme to project for us and to show us what the trading range is likely to look like for the day. So basically, we are projecting and looking at what the day might look like before it actually happens. All right, we are going to look at 3 consecutive days together here. These are the days, this one, and this one, okay? And we're going to focus on them and what happens relative to each other. I'm going to call them day 1, day 2, and day 3 to make it easy reference rather than using the dates at the bottom here, their recent trading activity. But I'm going to call them day 1, day 2, and day 3. So we don't get confused with prior day, next day, and so if I refer to day 1, this is the day we're looking at. Day 2, this is the day I mean, and day 3, this is our day 3. All right, let's take a look at them and see how we can in fact project for each day before it actually happens. We're going to begin by looking at day 1, and we're going to look at its range. And remember, we identify the range by looking at where the low is and where the high is for the day. And in this case, the low was 1278.50 and the high was 1288.25. So obviously, that gives me a range of 9.75. The way that I calculate the range is I take the high minus the low, and the number I get is the range. So the full movement for the entire trading day for the first day, or day 1, was 9.75. Since this is the ES Mini, it's really 9 3/4 points. That's the full movement of the range. So if someone actually was just a super hot dog trader, that is the most they would have made if they bought at the lowest point and sold at the highest point. That, by the way, is not really the intent of what we want to do or how traders act, but this is just to describe what the range means. Again, let me backtrack. It is this movement from low to high. That is my range. And we just identified from our calculation that this is 9.75 points. All right. Now, armed with this number, here's what I want you to do next. I would like you to calculate half the range, which is basically take this number, divide it by 2, and it'll give you half. By the way, this technique works for any instrument that you want to trade. It's a very powerful technique. Okay, we're going to approximate 4.875. We're going to call that 4.75 on the ES Mini. A quarter of my range is going to be 4.5, and an eighth of the range is going to be about 1.25. So now I know what the full range is: half, quarter, and an eighth. Very simple, very easy math. All right, now let's take a look at our second day, or day 2, as we decided how we would refer to it. And this is our day 2. And the first thing that we're going to look at is the open. Where did we open? And we opened down here. And the first question that we're going to answer for ourselves is, did we open inside or outside the range of the prior day? And the answer to that question is, of course, we're opening inside the range of the prior day. As a matter of fact, I still have the range on the chart here, and it's very easy for us to see that we did in fact open inside that range. However, we are on the low end of that range. The next question is, did we open below or above the value area or inside the value area? So the 3 questions are very easy to answer. Here's the value area of the prior day, 2 green lines for it. So I am in range, but I am below day 1's value area. All right, so I am in range, but below the value area. Now, take a look at what happens at the open. I get 1 print below, and price shoots upwards, okay, shoots upwards. And immediately I'm asking myself, is this an open test drive? It's not an open drive because we did have one single print below the open. Is it in fact an open test drive, and am I likely to see prices continue to move up? By virtue of the fact that I'm opening within the range, I should be cautious and not get carried away thinking that this is going to be a strong directional day. Yes, I did have a strong directional move in the morning, but remember, I'm opening within range, so I have to proceed with caution. So let's wait and see what happens at period B. And sure enough, period B opens down here at the low end of A and drops down to test the support level that we had, or the low of the day. And it holds. All right. Now, let's take a look at the initial balance range for day 2. Initial balance is typically period A and period B, so that's the first hour of trading. How much of a movement did we see in that range? 4.5. So, and the way that I got that, this was the high, and this is the low. These are the two numbers that I have here. I subtracted them, and it gives me 4.5. This is a rather big move, because if my total range for the prior day was 9 or 9.75, 4.5 is just about half that. So I saw half of my day's move in that initial balance area. Not only that, I saw that prices were unable to break below the low of the day. This helps me dramatically in identifying the extreme for the day. So it looks like we've put in the low for the day. So even if I begin trading with this information, now that I know I have the low behind my back, any longs that I take over the course of this day are going to pan out for me. Because the low is way down here, and I should feel comfortable with longs. Sure enough, the C period opens towards the high of the B period and continues on upwards. This is why it helps us to identify the extreme of the day as early as possible, if we can. All right, now, more importantly, what I want to identify is what is the potential trading day for day 2. So for day 1, we were able to calculate it, and it was 9.75. Now, what is the actual potential range for day 2? Well, we begin with the extreme that we just identified, and the extreme is at 1278.75, which is the low that we have determined. And we're going to add 12.78.75 plus the 9.75. So I would predict, or I would project, that if in fact things flow as per our diagnosis, that the potential range for day 2 is going to move all the way up to 1288.50. Okay, now I want to show you the actual high for the day. My projection was 1288.50, and the actual high for the day was 1288.75. Now, for me, that's pretty darn close. We're never going to be exact, although sometimes we will. You will be surprised. Sometimes you'll hit it right on the nose. But this is definitely going to get you in the ballpark. So what does that really tell me? That if I'm in a long and somehow prices drop back a little bit, I should not panic. I have a potential range all the way up. If I've been able to identify direction accurately and the low has been put in, I can be comfortable with any long until I get up to this range here. Then I should be I should be selling, taking my profits, because I know I've gone to the extreme of the day. You might say to me, well, sometimes the day will even move higher, and I will tell you absolutely. But this helps me as a trader to be conservative, to take my profits at safe points. I don't want to be sitting in the trade, in a long trade, waiting at 1288 for it to get right to 1288.5. I may very well decide I'm going to be out right at 1288. Give myself a little bit of latitude. So always allow yourself at least 15% leeway from the projection. After all, remember, these are projections, but this is how professional traders project the range for the day, and it dramatically influences their trading decisions. So this is a very important technique to learn. You're opening within the range, a little bit below value area, and you put in the low for the day, and you take the prior day's range, add it to the low of the day, and this will allow you to project the potential range for the actual day. All right, so like any magician, when they work, you look at the trick and you say, oh, okay, great, it works this time. Let's see you do it again. So this is why I am going to do it again for the next day. And now we're going to begin with day 2. And day 2 has the following range. Look again, here's the low, and here's the high. And hopefully by now, everyone is familiar with how to calculate the range for that day. And we take a look at where we open for day 3. Obviously, we are opening day 3 today within range and also within the prior day's value area. Take a look at where the value area was for the prior day. So now our job will be to try to see if we can in fact determine where the extreme is going to be for the day. All right, first of all, day 3 open is inside day 2's value area. Remember, the value area is right here, and we're opening inside. Yes, a little bit to the low end of, I'm sorry, to the high end of the, no, it is the low end of this value area here. It's good to, when you get too many green lines, it starts to get a little confusing, but this is our value area for the prior day, for day 2. Okay, and in fact, our open is on the low end of the value area of the prior day, but nevertheless, it's within the value area. Okay, so we begin our analysis since we are there. Is it inside the range? Yes. Do we have an open test drive? Yes, we do. What we have is we dropped down and we found support, and then we started a drive in the opposite direction. Okay, so immediately the first question that we're going to ask ourselves from our 2 favorite questions, based on what we see in period A, where does it look like this market wants to go? What direction is it trying to move in? And obviously, because we have so many more prints above the open, it's trying to go up. Okay? Now, how far up will it go is the question we don't know. Now, B period opens. Let's take a look at where B period opens. B period opens at the high of A period and continues higher. But notice where it actually finishes off. It comes back down, drops, whoa, and it actually pierces the open. So all of a sudden, after we were so bullish in that first period and we thought the market was going up, the direction has changed on us. Prices have started moving down, and all of a sudden now we're back to the lows of the initial balance area. And B period is down here. So what does this tell me now, just if I'm looking at A and B? Where is my extreme that is likely to hold for that particular period? And the extreme is the high, because we weren't able to move any higher with B. On the contrary, the resistance was strong enough, it pushed us all the way back down to near bottom, to near the lows. And so if I'm going to pick an extreme that's likely to hold, it will be the top extreme. And then I begin the process that we just discussed. Since we identified what the range is for day 2, let's calculate it. And the range is high minus low, so it's 10 points or 40 ticks because there's 4 ticks to each point. But let's go by the points. So full range, 10 points, half a range, 5 points, quarter range, 2.5 points, 1/8 of a range is 1.25 point. The reason I want you to look at the different pieces of the range, this will come into play in our analysis in terms of determining a strength of a move, and then sometimes we will also see ranges that are built up. We're getting a 1/4 and 1/8 of a move, or just a half and an eighth. This helps us to sort of gauge the momentum and the power of the moves. All right, so our initial range in this case was 1282 to 1288, and we've calculated that we have 10 points. So if this is our extreme, as we've identified it, we would add 10 points to our extreme, and then it should identify for us where in fact the range is likely to be. But before we do that, let me show you the initial balance was 6.75 of those 10 points. That initial range was quite wide as well. And when you see a wide range like that, one of those extremes, there's a high probability that one of those extremes will hold, as it did in this case. And it should not be difficult once you see that we're ending towards the low of the move, that it's the high that's going to hold. We're not going to be really going any higher because we've already dropped so much. We've moved quite a bit to the upside and dropped it all back. So obviously we weren't able to sustain it, and the high is going to hold. Now, let's take a look at where the B period closed, because that's our clue that helps us in identifying which end is the extreme that's likely to hold. And again, it closed towards the low of the initial bounce, and telling us that now we're moving in a lower or in a downward direction rather than upwards. All right, so let's now continue with our projection. So if we have our extreme high at 1288.75, now instead of adding to it, I'm going to subtract the prior day's trading range. 1288.75 minus 10 points, which was the range for day 2, gives us a close of, or a high for the range of 1278.75. Now let's take a look at the actual low for day 3. I estimated it or projected it at 1278.50, which would have been around here, and here's where the actual low was. Again, folks, not bad. This projection technique will help you a lot if you are in a trade and you want to project the potential profit in the trade. This would have been a very safe area to take your profits and exit. We never want to sort of maximize, get out at the extreme peak and go in at the extreme low. We want to be safe, we want to be conservative, and so we do these projections to help guide us. And so twice now we were pretty darn close. 1278.50 from 1277. All right, there was our projected low. All right, want to review now just a couple of key concepts. When we open within the prior day's value area, the market is in balance because nothing has really changed. We're still within the same value area. We try to determine the extreme for the initial period because that will help us in determining the projection for the range for the day, and we calculate the range for the prior day and then do our projection. I really want you to practice some of this, some of these techniques on your own. This is how you will really get them down, and you will be amazed once you get this stuff down. Man, you are going to amaze yourself at how well you're able to project and the level of confidence you'll start to gain with your trading. So I really encourage you to start practicing this. All right. Now, again, just a last brief example to look at how we identify extremes for the day. So a little video here, and take a look. All right, what's happening now is we're going up above the open, and then we headed down below the open, and I want to identify where my extreme is going to be. Now look at B period. Is it going to go? Yes, it goes up beyond my A period and continues up. All right. Now, if we were to look at this picture, where's the extreme that's likely to hold? Obviously, it's the low. Let's continue on and see if, in fact, we are right. All right, we never broke that low. So you need to develop the skill in being able to identify the extreme for each day. And it really is not a difficult skill. You basically need to analyze the two initial periods relative to one another. And when you also have a footprint chart open next to you, it should make this even easier and easier. Sure enough, our day is about to close, and we never did break the low that we determined very early on, and we're continuing to trade in the higher part of the value range.